It is a Sunday night in a 4-bedroom house somewhere off the GO train line outside Toronto. The lawn is cut, the driveway has 2 vehicles in it, a leased SUV and a 5-year-old sedan that's almost paid off. Inside, the kids are finally asleep, and a couple in their late 30s are sitting at the kitchen island with 2 laptops open. Combined, this household pulls in $200,000 a year. On paper, that puts them in roughly the top 10% of Canadian household earners. By every headline metric, they have made it. And yet, right now, tonight, they are quietly stressed about money. The credit card statement just landed. It's higher than last month. Again, there is a number in their heads that neither of them says out loud. How is it possible that we earn this much and still feel like we're one bad month away from trouble? This is not a rare household. This is one of the most common financial illusions in the entire country. Today, we are going to open the books on a $200,000 income and follow every single dollar. Because by the end of this video, you will understand exactly why so many high-earning Canadians live paycheck to paycheck. And it has almost nothing to do with how much they make. Let's start with the number nobody wants to talk about first: taxes. In Ontario, a combined household income of $200,000 lands you well into the higher federal brackets. And once you stack provincial tax, CPP, and EI on top, your effective take-home is not $200,000. It's closer to $148,000 after deductions, depending on how the income is split between the 2 earners. That's already $52,000 gone before a single bill is paid. Pause on that. Over a quarter of this household's gross income never even touches their bank account. It goes straight to Ottawa and Queen's Park before they ever see it. Now let's talk about the roof over their heads. The average home price in the Greater Toronto Area sits well north of $1.1 million. On a $1.1 million home with 20% down, that's an $880,000 mortgage. At today's rates, that's a monthly payment north of $5,200. Add property tax, home insurance, and basic maintenance, and shelter alone is eating close to $6,400 a month. That's roughly $77,000 a year, more than half of what's left after tax, just to keep the lights on and the mortgage current. Next, the vehicles. 2 working parents in the suburbs almost always means 2 cars. A leased SUV at $650 a month, a car payment on the sedan at $400 a month, insurance for both running another $500 combined, and gas. All in, transportation is quietly consuming close to $19,000 a year. Not because anyone is being reckless, because 2 commuting adults in a country built around the car simply cost that much to move around. Then there's daycare, and this is where a lot of 6-figure households in Canada actually get gutted. Even with provincial childcare subsidies expanding across the country, full-time daycare for 2 kids in the GTA can still run $1,400 to $1,800 a month combined. That's another $18,000 to $21,000 a year before a single extracurricular activity, before soccer, before piano lessons. Add it up. Shelter, transportation, and childcare alone are already consuming close to $117,000 of the $148,000 this household actually takes home. That leaves roughly $31,000 to cover groceries, utilities, phone bills, clothing, gifts, vacations, and any actual saving or investing. And here is where the real trap sets in. It's not the big fixed costs that break most high earners. It's what happens to the $31,000 that's left. This is where lifestyle inflation quietly moves in and takes a seat at the table. When you're earning $200,000, a grocery budget that would have felt tight at $80,000 suddenly feels unnecessary to track. Dinners out become a weekly habit instead of a monthly treat. The Costco run turns into a Whole Foods run. Streaming subscriptions stack up, 5, 6, 7 of them, quietly renewing every month. A gym membership here, a meal kit service there, a cleaning service because who has time to clean anymore? None of it feels irresponsible in the moment. Each individual charge is small. But StatsCan data consistently shows that as household income rises in Canada, discretionary spending rises even faster, and savings rates often barely move at all.
This is the invisible tax. Nobody sends you a bill for it. There's no line item called lifestyle creep on your bank statement. It just quietly absorbs the gap between what you earn and what you used to spend, until the gap disappears entirely. And this is exactly why a household earning $200,000 can end up in the exact same monthly stress as a household earning $85,000. The income went up, the lifestyle went up faster. The math simply reset itself at a higher altitude. So what do the high earners who actually build wealth in this country do differently? It's rarely about earning even more. It's about one specific habit. They fix their savings rate before their lifestyle has a chance to expand into a raise. The households that quietly build seven-figure net worths on $200,000 incomes treat their TFSA and RRSP contributions like a bill that gets paid the day the paycheck lands, automatically, before a single discretionary dollar is spent. When they get a raise, the increase gets split, half toward investments, half toward lifestyle, instead of the entire raise disappearing into a nicer car or a bigger house. It sounds almost too simple to matter, but the data backs it up. A household investing even $1,500 a month consistently at a 7% real return builds close to $760,000 in 20 years. The exact same household spending that $1,500 a month on lifestyle upgrades instead builds nothing but better memories and a maxed out credit line. The uncomfortable truth is this: income solves a lot of problems in life, but income alone does not build wealth. Behavior does. A $200,000 household with no fixed savings rate is often financially weaker than an $85,000 household that automatically invests 15% of every paycheck, because the second household has built a system that doesn't care how much lifestyle is tempting them. So back to that kitchen island. Off the GO train line, laptops open, credit card statements sitting between two exhausted parents. They are not failing. They are not bad with money in some moral sense. They are simply living out a very common Canadian equation: high income, high fixed costs, no automated savings rate, and a lifestyle that quietly grew to fill every available dollar. The fix isn't a bigger raise. It's rarely even a smaller mortgage. It's deciding today that a fixed percentage of every dollar that comes in gets paid to their own future first, automatically, before lifestyle gets a single vote. Because in Canada, the gap between looking wealthy and being wealthy was never about the number on your pay stub. It's about the number you never let yourself see, the one quietly compounding in an account you never touch. If you learned something from this video, make sure to hit that subscribe button. See you on the next one.